This is Lippy the Clown. Time for another lesson in accounting. Hooray! Okay, enough of that. We've talked about the concept of debits and credits and how increases in expenses are debits and increases in revenue are credits. But let's get to more mundane things like assets and liability. No, that's assets and liabilities. What is an asset? An asset is something that we acquire. Typically, let's use an example of a house. If you buy a house, you acquire an asset. However, because you owe money on the house, probably to your bank or friendly credit union, you've incurred a liability. You owe someone for their house. So you have an asset and a liability. Perhaps you might own a car, a Ford Mustang, perhaps. Wow! Okay, the Ford Mustang is an asset to you, but because you owe the finance company or the bank for buying that car, it's a liability. We've determined now that one can have assets and liabilities and income and expenses. Income is just another word for revenue. In terms of the accounting formula and debits and credits, let's look at assets. Every time you acquire an asset, it is recorded in an accounting record as a debit. However, if you reduce your assets or if you get rid of it, it becomes a credit. We can explain that in terms of charts, but that's the fundamental principle. As you increase your assets, it's a debit. Similarly to when you increase your expenses, those are debits too. Conversely, when you increase your revenue, it's a credit, and similarly, when you increase your liabilities, those are credits. So let's review. Increase in assets are debits. Decreases in assets are credits. Increases in liabilities are credits, but decreases in liabilities are debits. Now, how is that? Confused? No, you're not. Just review the materials. Maybe I'll put together some slides that you can look at, and that should give you a fair notion of debits and credits, assets and liabilities, income and expenses.